Hey, what's up, guys? Justin here, ConfidentOptions.com. We're back at work this weekend. We're reviewing trades from the last week, which was 9/4/2018 through, or 9/3/2018, which was actually a holiday, so 9/4 through 9/7. Hope you guys are having a fantastic start to your September. I was in actually Orlando last weekend, celebrating a buddy's wedding, visiting the theme parks, doing the whole thing. We had a blast, and I'm glad to be back, though. Back at it this week. So this week we had 3 closing trades. Oh, first, if you want to check out the closing trades and all the details, head over to confidentoptions.com/closed-trades, or you can go to confidentoptions.com, click on trading here, and then select close trade. It'll take you to this page. We'll post our most recent video reviews up at the top and the trades below that. Again, this is 100% free. Anybody that wants to check them out, please do. We closed 5 trades this week, 4 winners and 1 scratch trade. So overall, a quiet week for closed trades. But still profitable. We did open up 8 new positions, and we'll be reviewing 3 of those new positions after we finish these closed trades that we went through. So let's jump right into it and head down to our first close of the week, which was an IBB. In this guy, our technicals were signaling an overbought situation, so we sold the call credit spread above the market. We sold the 126, 128, so that means selling the closer one to the market, 126, and going out either 1, 2, 3 strikes and buying a put. This would actually be a call. Sorry about that. Buying a call above the market. That makes it a risk-defined trade. So in this case, we were able to collect 53 cents. A reminder for everybody, if you're new to us, you always want to try to collect a third of the width of the spread. So in this case, we have a $2 wide spread. So a third of that would be roughly 66 cents. As you can tell, we didn't collect 66 cents. Don't get too hung up on that. You just want to be in the ballpark. So above 50 cents was about in the ballpark for me. If this was trading for, say, 30, 35 cents, I probably wouldn't have taken the trade. It just wouldn't pay enough to make it worth our time and investment here. So that's our strategy. Let's head over to the charts and take a look at what we got going on here. So let's pull up our marker. This was the day we entered. So you can see the stock's been on a pretty big run, and it just now started showing some overbought signals that we use, and so those signals would prompt us then to sell above the market since we're in a scenario where it's been overbought. So if we move up our charts here, we ended up selling again the 126, so way up here, and then even further out we bought the 128. So this is our 128. And again, these are both calls. So call here and call here. This is our short call, and this is our long call. Makes it risk defined. And so what we're expecting is it can move as much up to this as it wants. So it can move like this and keep moving higher. As long as it finishes below our short strike before expiration, that's where we make the profits. We could make potentially full profits, which would be $53, depending on how many contracts you trade, depending on your account size, of course. But our target on these positions is 50%. So as soon as it started moving back, we were actually able to close the position out. I think it was like Tuesday when the market opened after the holiday. So one of these days here, as it moved back, the premium came out of the contracts, and we were able to close it out. So it ended up being a good trade for us. We do it 100 out of 100 times. Anytime we see those signals, we jump in. So that was our first winner. FXE is a fantastic case study. We'll probably do a whole series of case studies when we have a little more in our backlog here, but this is a good example of why we roll and why we adjust and why we do it mechanically. So let's step through this. We opened up the trade, and this is why I purposely wanted to take the time and effort to put all of the legs into one table. That way you can see exactly what we're doing, exactly where we're moving and where we're going. It just makes it hard if I were just to show you this. It doesn't really make sense because you'd have to know what occurred before that to get to the closing price and to get to basically why we scratched the trade. So when we opened on 8/6, we sold the 113-108 strangle. We only collected 66 cents. We did, however, adjust as it went against us. So the trade moved lower, and so we moved the 113s down. So we closed these out, close them out here, and we opened the 111s. So now we have the 111 call, 108 put. We ended up on the 30th hitting about that 21 days till expiration point. It was actually, we were trading in September. We were trading 21st of September, and we rolled out to October. So once we hit that 21, 20 days, we always want to roll the position if it hasn't come in as a profit yet. If it's profitable, we'll go ahead and just take it off and redeploy the capital in a new trade and close the trade out. In this case, it was not profitable yet, and so we went ahead and rolled it. And by rolling it, all we're doing is taking the 111 and the 108, what we already had open, and then closing them out in September and opening back up in October. And we collected a premium to do that. So we're getting paid to extend our duration. Anytime we can get paid to extend the duration, we're going to do that if it's in a losing trade. Now, if I wasn't able to get paid on this, I would have had to close the trade and take the loss. There's never a time where I'm going to pay to take on more risk and take on more time. So again, you always want to get paid, collect more premium. So we ended up collecting 65 more cents in the trade. So that brought our total credit up to $1.52. And whenever we roll something, we're really just looking to get out at a scratch or break even or very close to that. And so we were able to recoup all the paper losses that we had and close it out for $1.52, making it a scratch trade. Again, anytime we have one contract, we do these wins, scratch, and losses based on one contract. So if the contract is less than $10 winner or less than $10 loser, it becomes a scratch trade. So heading over to the chart, kind of do some examination here of what exactly happened and why we stay mechanical. So this circle here is the day we opened the trade, and again we sold the 113.108. So up here we got the 113, on down here we got the 108. So we had a big gap down a couple days after we opened up the trade, and so we let it kind of finish its move out, and we said, all right, it's time for us to adjust this trade. Our short deltas on our put side have breached the I think they are at about 40 delta at that time. So what we're going to do is move the 113 call. Remember, this is a call up here. We'll just move it down ever so slightly, not super aggressive, but we move it down to 111 right here. So you can see it actually ended up biting us a bit because the stock rallied pretty hard all the way back up now through our short strike on the other side. So it's like a give and take. We're going ebbing and flowing with the market. And so on this day here, expecting cyclicality in the market, we went ahead and rolled out the contract. So we opened up the same 111, 108 just in the next cycle. And that allows us to collect more premium, which allows us to push these out on both sides, push our break evens out. Stock moved back as expected, as it's kind of been cyclical over the last couple months. Moved back in. We're able to close it for a scratch. We close it and move on. No harm, no foul. We stay mechanical. Who is to say that this move wouldn't have continued lower? We just never know what the next move is going to be. Of course, hindsight is like, why don't you just stay with the original position, 113, 108? You never breached either of those sides, so you go ahead and collect a profit and a win on the trade. The problem is I've been in more trades than I can count that this move didn't stop. So this move maybe continued lower, and then it kind of fizzles out, and then it continued lower, the next leg down. It just so happens that it rallied pretty strong. So we never pretend like we know the direction of the stock or the market in general, so we always just kind of ebb and flow as the market ebbs and flows. It allows us to stay profitable and continue to pull money out of the markets. All right, heading back over to our trades. Our next close was kind of a core portfolio position in CMI. We had the strangle, the 150, 250, and the 136. We collected $2, nice and rich on our entry, and we went ahead and closed it out when we hit that 21 days till expiration, which is our key. We didn't hit our 50% target. However, we had a profit, so we went ahead and closed it, and if we wanted to open up a new position in CMI, we would close out this trade and open up that trade on the October cycle. So heading over to the charts really, really quick. I do want to get to our new trades from this week because I think there's some value in looking at those. I don't know what's going on with my charts here. Let's zoom out, zoom in. Adjust this a bit. Make sure we can get our strikes in range. So the stock's just kind of been meandering around here, kind of moving up slowly. So right here, we went ahead and took in a position on CMI 150, 250. So that's this up here. And let's see, one down to 136. Not a super large range, but this stock, you know, it doesn't move a whole ton. So that, I mean, we're just pricing in kind of our typical 16 to 20 delta strikes. And so that's what we do. We keep it very mechanical. Stock ended up going pretty hard against us. It was too early, though, in the cycle of when we're holding this thing to just give it some time to come back, be cyclical like typical markets are. And so we just hold on to both, and we went ahead and we're at the 21 days till expiration here. So that's where we experienced the highest gamma risk. And so that's why we close out the position since we had a small loss. Went and closed out, took our profits, and moved on. IB rank's climbing up. So once this thing hits over 50 again, we'll go ahead and probably open up a new position. I don't think we have earnings coming up in the near future, but of course we'll always check that before we get into a trade. All right, two left. EWZ has been on everybody's radar. IB ranks, I think, at 99 or 100 now. But back on the 22nd of August, we opened the 35.50 29 strangle, and we went ahead and closed it again when we got to that 21 days till expiration. We took what profit we had. We didn't quite hit the 50% mark, but we took the profit that we had, closed out of it, and moved on. We have several new positions that we've opened in EWZ just because the IB rank is so high in the stock. It's actually an ETF, but all the same to us. So yeah, 97 IB rank. If you use Tastyworks, Tastyworks platform, it's right here up at the top. So I think we entered another position here, another position here. I mean, we've just been slowly laddering in. On the move down, we entered a position there. But this is the position that's in question, or that we closed out. So we ended up selling the 35.50 up here. So you can tell when the IV gets so high, you can get a good range around the stock. And so 29 is actually lower than what we can see here. So kind of meandering right and kind of not doing anything. Actually closed the day we opened it about the same place that we opened it. So nice little trade there, good profit. Staying mechanical as usual, opening up a new trade if we need to close out and get on to the next. Our single loan earnings trade of the week was MRVL. I think it's Marvel Technologies. This was the only earnings trade of the week that we actually had an edge. Of course, it's not really earnings season, so we don't expect to have a ton of these trades, but this was one that proved out for us. We always want to know that the standard deviation move, or that the expected move, is greater than all the past one standard deviated moves. That gives us the edge in the stock, or in the trade. So here's Marvel. It closed down way lower on the day that we actually opened the trade. We opened it right at the close here. Opened up way up here. We sold the 21.50s though, and we had, I think, the 17.50s below what we can see here. Stop opened up. It challenged us on the top side. It immediately sold off. We went ahead and closed out the trade as soon as we could, and we closed out both sides, which is what we typically like to do as long as there's ability to get out of them. It just eliminate the risk. I've had too many situations where this move, maybe it continued all the way through our short cycle, or our short put, and then we're stuck, right? So that's the way it goes. We went ahead and got out. It was a good profit for us, a 10% return on capital, and you couldn't trade a lot of size in this, so that's why we only took the example contract size up to 8, make about $200. Good little overnight trade. No management needed. Get in and get out. It's the way that we like it. So let's quickly talk about our 3 of our 8 new positions from this past week. Some of the movers recently. BABA being number 1. We have a nice high IV rank. So perfect time for selling premium. On 9.5, we entered a trade here this day where we sold the 185s all the way up here and the 145s down below that we can see. Gives us a nice range. The stock's kind of been beaten up. IV rank's up, like we said. There's a lot of premium in these contracts. It takes a bit of money to be able to hold these trades just because the stock size is $1.62. That's a lot. If you were to sell a bunch of contracts. So what we're doing is just selling one contract on these and kind of what we consider laddering in. So we actually had a trade 2 weeks ago up here. It's gone against us, so we'll just continue to ladder these legs in. And then once we hit a point where we're pretty heavy in the stock or in the specific industry, we'll stop laddering in, and then we'll start adjusting from there. So it's kind of a cyclical thing that we do. It's very mechanical and getting in and getting out. As soon as we have our trade alerts live, these will come out right when we enter them in, so it gives you a good idea of what we're doing. Facebook number 2, nice high IV rank compared to the overall market, 52. So again, our level is always going to be that 50 level that we want to get in. So we got in on this on the 6th, so this down day here. We sold the 180s, so all the way up here. and we sold the 145s, which we can't see on our screen. Gives us a nice wide range, lets the stock kind of do what it wants. If it moves against us this way, we'll go ahead and just roll this down and continue collecting premium and until we get to our 50% profit target and then get out of the trade. Lastly here, everybody's darling child this past week. It's been all over the news. I don't know if it's Elon or if it's tweeting or if it's actually problems with the company. Doesn't matter to us because the IV rank is way through the roof. We were selling premium back up in here and got out at this bounce here because the IV rank, I think up here was about 100 as well. And then in this point right here, I mean, it crushed down to like 60 or even 50. So it took out half of the implied volatility just in a couple days. So of course we get out of those trades when they go our way that quickly. But what we ended up doing in this guy is selling the put credit spread below the market. So our signals are starting to, our indicators are starting to signal us that this has become an oversold situation. And it actually only started occurring almost down on this day or even this day here. And so all this time we avoided a trade on the, a bullish type of trade just because our indicators were telling us it wasn't ready yet. Now it's telling us it's ready. So what we're doing is selling the 30 deltas. So we ended up trading the it's actually a little bit lower, 245 and the 240 put credit spread. So what that means is this is our short leg and this is our long leg. So it becomes a risk defined position. Because it's risk defined, it's a high price stock, and so I obviously want to make it risk defined in case this continues to go lower. It's not going to be a big deal because it is risk defined. It's not naked in the fact that you could potentially lose as more money than you put into the trade. So we want it to be risk defined, obviously, but it gives us again some space for it to, if it wants to continue lower and then kind of decide to come back, we'll see. Of course, we only do one contract on these, so we'll end up probably adding another leg to this. If it does get down to the 250s again or 255, we'll just step our next position a little bit lower. We don't ever adjust defined risk trades. There's just, when you're buying further out legs, it becomes kind of a zero-sum game. And so what we will do, though, is roll. So we'll roll positions out. If say, Tesla drops to 240, 230, we'll roll to extend our duration as long as we can correct credit on that trade. Because it's risk-defined, there's no issue. As long as we continue to collect premium, we're okay, and we'll just let the stock do what it's going to do and keep adding positions or rolling positions as we need. But again, the key is you always want to be looking for things with the high IV rank. I mean, it can be counterintuitive for some people. It's like, why would I want to trade something that has a high IV rank? Because doesn't that mean it can move more than it has in the past? Absolutely. That is what it means. But we know from our back testing and all the research that we've done and the research that other people have done is that IV implied volatility is always overstated. And so when implied volatility is high, we have the ability to sell contracts at a higher price or a higher premium than they normally would be. And so when that IV comes back in, because it's always mean reverting, stochasticity is what it's called. It's the only thing in the market that mean reverts back to a mean or an average level. And so we can count on IV coming back in. We don't know when. We don't know how long it could stay up at 100. We don't know any of that. But we know that by the backtesting and the research that we've done, that we put the edge on our side when the implied volatility is high. So I hope that's helpful for you guys. That's going to be it. I know it was a little bit longer video today, but hopefully that gives you some insight on what we're doing, what we're trading. We're hoping to get our live alerts out sometime this year. We've got still some work to do on the back end, making sure that everything's seamless on that. But I think it'll be huge for people that are trying to learn about options, trying to trade options, trying to generate income. It's a big deal in that learning process to kind of see what we've been doing. We've been doing this for 4 or 5 years now, and so we have some background and some knowledge that we've collected over time, things to do and things not to do. So we hope that you can find that helpful in your journey to become a successful options trader as well. With that, I'll sign off. Have a fantastic week. We'll see you guys over on Instagram, at the website. Stay in touch. Send us comments. Send us questions. We'll be happy to answer. Have a great week. Bye.